Welcome back, everybody. This is Carl from the Bullet Bear Report, also Investing for Life. I'm going to try to change the name. Today's video is about Dave Ramsey, my thoughts and opinions, and what we can do to do better than what he's saying. Like Dave Ramsey's program, Supercharged. I've been an investor for 25 years. I'm a business owner, entrepreneur. I own some real estate, my own home, multifamily incomes, and things like that. And honestly, as a small business owner, I've been actually I've followed the principles for the last 25 years without even realizing it. I've always tried to pay down all my debts, the mortgage paid off as fast as possible, things like that, which are just core key principles. As a small business owner, you always want to be protecting yourself from a downslide in the economy or a negative impact of business customers, things like that. So I was always more of the conservative person being an entrepreneur. So I found him only like 2 years ago, and I was like, wow. I was like, we're on the same page here. But the only difference is that we can do better than what he says regarding investing your money. Now, that's very important to accumulate wealth, is investing and compounding your returns over time. Quickly, it's risky. Longer strategies, it's a steady climb of investments that over time inflation will create you wealth. Now, real estate inflation, I'm going to get into a separate topic video about that. I don't know what the potential is for the future due to income stagnation, things like that of the middle class. But that's another video. Today we're going to talk about how we can invest better than what Dave Ramsey said. Because Dave Ramsey, one of his things I don't agree with is he just says, put it into diversified mutual funds. Put it into international and this and bonds and whatever, diversification. You know, that's a strategy for mediocre returns, okay? If you're happy with mediocre returns, that's fine. I mean, just pick your Fidelity mutual fund or whatever, top whatever performance. You get your maybe 8, 9%. I don't know, 10, 11 is kind of high. We can do better than that just on our own. Now, if you have small money, I advise then just to put it into simple ETFs that charge no fees. They're just a commission and that's the end of it. So like two mutual ETFs I've been talking about for years to all my videos. I've done lots of videos which I took down afterwards. But one is the IVW, which is the S&P 500 growth fund, has the best companies out there on it, growth companies, safe and diversified, over 100 stocks. So that's one thing you don't have to worry. And then the DVY, which is a dividend, Dow dividend kind of dividend yielding ETF, which gives you, I think, like 4% dividend, plus it has growth potential. Now, obviously, the more dividends you get, the less growth you might encounter because they're better companies. Philip Morris, McDonald's, Johnson & Johnson, and so forth. So you have a safer, but still, that DVY and IVW combination blows away any funds that Dave Ramsey is telling everybody to buy. Now, your only thing you have to do is invest into it every month. Now, that's the key. If the market goes up, keep investing, but try to generate a little more cash on the side or accumulate on the side. But keep investing a little bit. Let's say you have a $1,000 a month strategy, $1,000 a month of putting away. If you can do that, he advises 10% of your income, 10 or 15%, for retirement. I do the 10% plus another 40 or more for my personal accounts to invest in for my future and financial freedom. Now, I'm already a millionaire when you count in real estate and stocks, and I have a commercial building that I operate my business out of. So, but you don't feel like a millionaire because I don't have $2 million in cash or in liquid investments. That's where we all want to be. Once you get to that 2 million mark, you make 10%. That's 200,000 income, or you could pull out, and the capital's still there. So that's where we all want to be. Now, he generates average returns, and international is very risky. Everything seems great right now. All these money managers are like international. But when something goes a little bit south, the U.S. market goes down, but international goes down even more. We've seen the Chinese markets, the European markets just go down day after day after day after day, worse than the U.S. markets. So there's more risk when you invest into these international funds. But when you're investing in IVW or DVY, Johnson & Johnson, McDonald's, Starbucks, Facebook, They're international companies. You are already diversified by owning those 2 ETFs. So the simple strategy, if you have less than 20, 30, 40, 50,000, is stick with those 2 ETFs. And when the market gets hammered for some stupid reason, oh, Trump's going to get impeached, you take a little bit extra of that side cash, you put a little more in there every like two couple days. Because we've seen markets go down for one day like it did a couple weeks ago when the Trump impeachment BS went on. And today is May 26th, so relevant in time. If somebody's watching this video a year from now or two, then it wouldn't be relevant because you're like, Trump impeached. Yeah, it was in the beginning of his term, like the first couple months, and they're already trying to like scream and yell how he did something. You know, it's all nonsense. Politics at its worst, okay, people? That's why I try to turn the TV off, because it's such a distraction. So anyway, so we want to invest in those 2 ETFs up to 50, 60,000. Once you start getting to the 70, 80, 100,000, you can start to diversify a little bit more, and you sprinkle in some companies that you think are kind of outperformers. If you have that kind of capital, you should be reading all the time. Barron's, Investors Business Daily, 2 very important tools. I don't like Wall Street Journal, not too biased. So business magazines and even the magazines, they're not so slick. They're always bandwagon followers. Investors Business Daily, Barron's. Investors Business Daily, the reason I like that is it gives you a trend indicator. Once the trend turns under pressure and then down, that's when you should start getting like, all right, now's the time to go shopping. It's like stuff's on sale, especially ETF like the IVW and the DVY, because when the smoke clears and the panic sets aside, they come roaring back in because there's nowhere else for the money to go. So you're buying on the dips. Last January, when we had that panic in 2016, the beginning of the year, markets went down like 10, 14%. I was buying IVW hand over fist with the money I think I was going to invest for the next 2 months. I was like, you know what? I'm going to pull that money forward. I have a little money in the bank account. Use that cash. All right? That was the cash I was saving up. Emergency time here. I thought this Trump thing was going to blow into a few more days, maybe a week. And I was like, all right, wait 2 days and then kind of settle out a little. Then you buy a little heavier. Never happened. One day down, Trump, boom. Next day up, third day back up. A week, oh, we're all-time new highs. Too much money's out there. Dave Ramsey's strategy is super conservative. I mean, it's one step above bonds. I mean, 7, 8%. A lot of these mutual funds aren't going to do so well because their mutual fund managers are too conservative and they're over-diversified. So now those 2 ETFs are great for starting investors to get to your 100,000 mark or whatever you're going to be at. Once you get above it, 200, 250, 300 and higher, you can diversify with some stocks maybe that you see that are bargains. Like today I saw an article in Barron's about a couple weeks back or a month, Goodyear Tire, American company, beaten down. Trump is, the Republicans might pass a tax bill. That stock is going to increase. I like buying value stocks that are undervalued. Another one I bought a year or more ago was Alcoa before the split. Dirt cheap. Used to be $40-something, went down to $9. The insiders were buying. That's another thing. Find the page for insider buying. Look at, there's like I'm going to put the link below for the website page. Key insider buying. Look for companies that you recognize that are beaten down and the insiders are starting to buy a lot of shares for. That's where you get ideas from. Then you do a little research, see what their revenues are, things like that. And then I get into more sophisticated analysis tools if you get up to real money you want to manage yourself. And then if you have quite a bit more than 200,000, you can diversify into strategies like I have on one of the first videos we did over here, how to generate 25% or 24% per year. Compounded, that's like 42, 43%, 44% compounded. On one of my strategies I've used using software, VectorVest software, because I've been investing for 25 years and I've tried it all. And it picks 5 stocks, growing stocks, S&P 500 that are in uptrends and takes profit and stop losses. It's all computerized. But that's for people who want to maybe set aside, all right, 50 grand and use it for that 5 stock strategy. But the core of your investments are like Berkshire Hathaway. One of my core positions, 15, 20% of my position, 15. I think that's 15%. Another core position, IVW, DVY, gold, 10%, and silver a little bit, just for crisis of currency. Now, Dave Ramsey says don't own any gold. Look at his insurance. If the market is going to crash which I really doubt it, because we might have corrections, but a crash like 08 or 09, government won't let that happen anymore, because too much money is in it for pensions, retirements. Government agencies have money invested there. It's not in their interest. There's too much danger if a market goes down 50%. So guys, let's keep this simple and short. 10 minutes already. Stay diversified. Stick with those 2 ETFs. Keep investing every month like it's your mortgage payment, and it's the most important thing in the world. And then eventually you get to that mark where you have your 10, 50,000, 100,000, and then once you get to 200,000, then you could diversify into other strategies I have. If you already have 200, 300, 400,000, then take some position and check out my other program. But the thing is, you could do better than his Fidelity and international funds, and I just totally disagree with that. Mutual fund managers are underperforming. They have too much cash. They don't know how to do, and they can't take the risk of underperforming the market. So they try to be over conservative, then they just underperform. Because when you own every stock in the fund, in the mutual fund, you might as well just buy yourself the IVW ETFs and the DVY and just forget about it. Okay? So this is a little advice on how we can supercharge Dave Ramsey's strategy. I hope you enjoy this video. If you like it and you got information out of it, please like it and subscribe below, because I'm going to be doing more videos on how to become financially free, how to invest for yourself, like principles I've learned over the years on how we can get ahead of this massive inflation wave and become financially free. Okay? I'm going to help you guys out, and we're going to be on that journey. So join along, subscribe, and I'll see you in the next video. Take care.